Good day, welcome to today's class. If this is your first time on this channel, please click on the red subscription button to subscribe to this channel so that when we drop more videos, you will get notified. So in today's class, we'll be doing how to calculate CIT using the gross turnover basis. So the question is, why do we use gross turnover basis to calculate CIT? We all know that CIT is meant to be applied on the profit of a company. But how come we use the gross turnover? And another thing you need to know that whenever we talk about gross turnover, we are trying to say the total revenue generated by the company before deducting any form of expenses. Yes, your total revenue before any form of expenses or cost of goods sold, before you deduct cost of sales or anything. That's what we mean by the gross turnover of a company. And sometimes we apply tax on it. There's a way we go about it. And there are reasons why we might decide to use the gross turnover. Majorly two reasons. And number one is that if the profit of a company is not readily available, or it has not been ascertained when when the tax authority have come to collect their tax, there's the profit, the profit that the rate will be applied on is not available yet. So they can decide to use the gross turnover basis. Or perhaps the tax agents notice that this profit that you are giving is not actually true. Yes, or they notice that this profit is lesser, or they notice that there is something wrong with this profit. This profit should be more than this. They can decide to use the gross turnover basis. For example, let me give you a good example. Let's say the profit of a company, sorry, the revenue, the gross turnover of a company is 100,000, and you end up having a 500 naira profit. So how do you come from having 100,000 sales? You make a sales of 100,000 and you are having a profit of 500 naira. So the tax authority in this case can decide to use the gross turnover basis because they believe that this profit is not true. So we are going to take a question and we see how we go about it. But let me just explain randomly using what I have here. If in this situation now we have something like this for a company, the tax authority can just believe that they can just do that. Okay, since your gross revenue is 100,000, they can just assume that 20% of this your gross revenue should be your profits, and that is what they are going to use to estimate your tax and whatever thing they are going to estimate. So they can apply any rate. They can say 25% of it is your profit. They can say 20% of it is your profit, and that's what they are going to use, and that's final. So that's the case of what we'll be solving here, and we are going to use gross turnover to estimate our profits. So let's go with the question without wasting much of our time. Let's go with the question we have here. It goes thus: Ojokoro Nigeria Limited is engaged in general merchandising. The following details were extracted from the tax returns submitted to the FIRS, Federal Inland Revenue Service, for assessment year 2020. So they have a revenue of 100 million and accessible profit of 5,850,000, which is very, very low. We have a balancing charge of 500 less unrelieved loss brought forward of 1.2. We have capital allowance of 2.5, and we have the total profits according to what was computed of 2,650. So the company income tax rate was applied, and that was 795,000. So it goes thus: a desk examination by the inland revenue officials revealed the following: A, revenue was understated by 5 million naira. B, expenses were overstated by 1.5 million naira. The tax officials observed that the accounts submitted by the company were not reliable, and that based on industry average, the gross profit percentage of about 10% reviewed by the company account was not reasonable. Accordingly, the revenue decided to revise the company income tax computation by applying a fair and reasonable percentage of 25% on the revenue. So we are required to recompute the company income tax liability for 2020 year of assessment. So this is the question. You can see that in the question we were told that the revenue was understated by 5 million. If you are understating your revenue, it's because you want to pay lesser tax. You are evading tax. Let me put it that way. So you are overstating your expenses so that you can reduce your tax liability. So all these are what is devised to reduce the tax that we're paying by a company. So That is why the tax authority has decided that we should apply a fair percentage of 25% on the revenue. So 25% of the revenue is going to be the profit of the company, and that's what we are going to use for the tax. So let's go. So we have, what's the name of the company? We have Ojokoro Nigeria Limited. Ojokoro Nigeria Limited. So we want to recompute the company income tax for 2020 year of assessment. So the first thing we need to do is that let's go with our revenue. Revenue, because it is from the revenue we are going to apply the 25% to get our profit. So the revenue from the question given, we can see that the revenue is 100 million, 100,000, but in million. And we were told that revenue was understated by 5 million. So the revenue is 100 million, or let me just say 100,000 plus 5 million. So let's put it that way. So if we add this together, we're going to be having 105 million back. We'll be having 105 million. So a million like that. Let's put it that way to shorten the three zeros. So having this, we're going to apply 25% on this revenue, and we are going to use it as our profits for the company. So we go 25% of this. So we have our revised profit. Revised profit will now be 25 over 100 times 105,000. That gives us 26,250. So this is the profit of the company that we are going to be applying whatever we want to apply on it. This is the profit. So it is from this profit we will now take our, if you have capital allowance, if you have any balancing charge, we will now do it on this profit. So that is how to go with calculating CIT based on the gross turnover basis. So 26,250 as our revised profits. Then let's continue. From the question, let's go back to the question now. We're told that the company has a balancing charge of 500 naira. Yes, balancing charge of 500 naira. So we go. What do we do to balancing charge? I think I've explained that in my last class. That balancing charge will be added to the profits. I've explained that in one of my videos. So we go. Balancing charge. Balancing charge of 500 naira. 26,750. So from the question again, if you go back to the question, we have unrelieved loss brought forward. So unrelieved loss, we know that loss are meant to be subtracted, right? Unrelieved loss, and we have capital allowance. So if you don't understand all these things, just watch out for my video on capital allowance and company income tax. You understand why we need to add and subtract all these things. So going again, we have unrelieved loss brought forward. So unrelieved loss, we are going to less down also. Unrelieved loss of 1,200 from the question. 1,200. So 25,550. So now, and lastly, from the question, what we have is capital allowance, and capital allowance also is meant to be subtracted. So capital allowance of how much? Of 25. So capital allowance of 25. So we go capital allowance of 2,500. So 23,050 naira. So this will be our total revised total profits. Revised total profit. So to calculate CIT using the gross turnover basis, you just use the rate that was given by the tax authority and you get your profit straight away. You don't have to stress yourself. Then if you have balancing charge, balancing allowance, if you don't understand how we get all this, I said it. Watch out for my videos on capital allowance. Of course, if you have not watched out for those videos, you need to watch out for them before this one. My videos on capital allowance and company income tax, the first video. This is the third video. So watch out for them, you will understand. So this is our total profit. And from our total profit, we are going to apply the CIT rate, which is 30%. So CIT at 30%. So 30% of 23,050 will give us 6,915, and this is 6,915,000, because don't forget that everything is in million. So 6,115,000 will be our revised CIT. Don't forget that our CIT from the former question, from the question that was given, was 795,000. But after reviewing everything, revising everything, we have 6,915,000. So we've come to the end of this class on how to calculate CIT using the gross turnover basis. In our next class, we'll be doing how to calculate CIT using the dividend basis. So watch out for those class and many more videos. Thank you. See you in our next video class.